Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management. Okay, there we are. So welcome everyone. We've got the pleasure of listening and hearing from Paul Connor today of Connor Investment Real Estate, based out of Houston, Texas. Just broke bread with Paul a few weeks ago down in Houston, and nice and warm there, and it's warming up here in this part of the world too. Spring is here. So Paul, we're just going to hand it over, just to have a general discussion about your business, maybe go through the markets first, and then some specifics on your business, and then what maybe we can expect out of some of the funds we have with you.
Sure. So Connor Investment Real Estate is a private real estate investment firm. We focus primarily on large-scale residential developments and different investments within those. And then we also focus on manufacturing and industrial related activity. So within the residential side of it, Texas is currently home to 4 of the top 7, maybe top 8 single family home markets within North America, namely Dallas, Houston, Austin, and San Antonio. At one point in time, I think those 4 were actually all in the top 6 in North America as far as volume of new home sales. So we've seen over the last decades multiple opportunities within the Texas market in the residential side because of continued economic growth and frankly just continued population increase driven by, 1, just organic growth, and 2, by migration trends which continue to feed population into Texas. Houston just as our home base, and so we watch it and have a lot of opportunities here. We're averaging well in excess of 100,000 new residents to the Houston metropolitan area on an annual basis. So literally, we've added 1 million people just in the last 10 years here to the greater Houston area. And so as we continue to have that job growth and more importantly, the population growth, it directly leads to opportunities in single family housing development and the necessity for both that and multi-family style development. So we, as a market here in Houston, as an example, will do 34 to 36,000 new single-family home starts kind of over the next 12 months as we continue to move forward. Dallas also will be in that ballpark of probably the mid to high 30,000s as we continue to move forward. And that hasn't changed too drastically since we saw the peak in 2022 when we had a really low interest rate environment. And even at that point, we topped out at roughly 40,000 new single-family homes per year. So even though we've seen a moderation of it, it continues to be pretty robust and strong. And it's driven primarily by job growth and population growth within all these metropolitan areas of Texas. So one of the things that we evolved into or found opportunities in post-2008 great financial crisis, the banking laws changed dramatically as part of the Dodd-Frank Act. And so some of the restrictions on that limited where traditional banks could loan. And so one of the industries that was hardest hit or changed the most because of that was horizontal master plan communities for single family residents. And from the, limitation of the availability of debt as a part of that, created an opportunity for us in what we call passive land banking. And so we do land banking probably a little bit different than most people are used to. At the heart of the deal, we come in and buy the large scale property. And so in some cases, it could be up to 1,000 acres for what will eventually become a master plan community, municipal utility districts, and have to create their own, basically little city. So they'll put in the water treatment, wastewater treatment, drainage, detention, roads, amenities. And so all of these things go into these large scale projects, which is very capital intensive. And so a developer may have a ideally located piece of property and simply not have enough capital under a traditional equity and debt structure to build all this out. And so what we will do is we'll essentially be the capital behind the future phases of land for development with that developer. So if we're buying, just as an example, 500 acres, the developer would purchase the first 100 acres, put in the water plant, wastewater plant, all the essential infrastructure that would be for not only that first phase of development, but would also feed into the latter phases. We buy the property that is now entitled, engineered, but not yet developed for the remainder of that project. And then the developer is able to buy it phase by phase by phase. And in doing so, I was able to secure lending that's in more bite-sized increments so that it can still work within current lending environment, but it's a very different model than, call it, pre-2008. And so as a result of that, we continually have opportunities with small and mid-sized developers for these master plan community developments. And we come in with a structure that, in our opinion, offers almost the safety of a debt position, but with returns that are closer to an equity position. And we do so in a tax advantageous way that allows us to realize capital gains on 95% plus of the transactions that we do within passive land banks. One of the key elements that we have been working with McNichol on has been as an investor in these land bank opportunities, which continue to perform well. So when we do these structures, we typically will target roughly a 20% per year gross return, with it all being capital gains. Net, back to the limited partners of McNichol and our other partners that invest, we'll typically see 15 to 17% per year annual rates of return. And again, all of them on a capital gains basis. So it's a proven, consistent methodology of investment that we have done as we continue to move forward in different projects, both here in Houston as well as in other areas in the Texas metropolitan area. And so it's continued to work well, and hopefully it's been something that has served, I guess, the investment objectives of McNichol well over the years.
No, it definitely has, Paul. And, thanks for that sort of intro portion of your comments. Wanted to talk a little bit about Windy Hill Development, because firstly, they recently, I think, sold a just over 90 fully developed lots to DR Horton, but also because we're partnering with them through your company on Sealy 300. But one of the things I wanted to talk about was just sort of from a political, like a perspective, not to get political. Randy Hall was testifying this time last year, I think, at the Texas state legislature, just sort of talking about housing. And how does that link to your introductory remarks? To me, as one of the managers here, it's beyond obvious. Like it's crystal clear, the strategy. But maybe just for some of the folks up here in Ontario, what do you think about what Randy was telling the politicians?
Sure. So Randy Hall, who's one of the principals for Windy Hill Development, which is one of our preferred developers that we've done multiple deals with over the year. They've got a great tradition, great experience, great track record in their master plan community developments. And one of the things that not just Randy Hall and us, but frankly, a lot of the civil engineering firms, developers, and different groups that are in this industry that we continue to push for is to maintain an environment that allows for healthy but affordable growth, specifically within the residential side of things. And so one of the issues that we were paying attention to is, as regulatory environments were becoming more restrictive, and specifically within cities and ETJs, or extraterritorial jurisdictions of those cities, it was very restrictive to our ability to continue to develop affordable single family housing, simply because of the minimum requirements for lot widths or different requirements, whether it be on roads or sidewalks or setbacks. Every time that there is a regulatory change, that no matter how well intentioned it is on changing development codes, it necessarily will have a ripple effect. And one of the things that we have continued to push for is to make sure that it does not create a prohibitive environment where it makes building more expensive. One of Texas's key competitive advantages has been we have a very moderate to lower regulatory environment, which has allowed for a remarkable amount of growth over the last 10, 20 years in the Houston and other metropolitan areas. And so one of the things that we continually watch, both at the legislative side as well as at the local municipal side, is changes in regulations or in codes that necessarily restrict or reduce the ability of development, especially when it's on areas where there was always the path forward for residential development, and then changing of codes or regulations that all of a sudden restricted or prohibited or eliminated, which in our opinion is somewhere between restrictive and in some cases, it just almost constitutes now taking from what a private landowner can do on their property. We're just wanting to make sure that all the rules are out, obvious, and clear to the developers and engineers, and that we don't have situations where you have evolving, changing projects or changing regulations over the life of a project. And so that's one of the things that Randy Hall and I pay attention to, and that we're very aggressive on working with both cities and counties on putting it forth development agreements or long-term agreements so that there is a clear path forward, not for while we hold the land as part of our land banks, but also for the developer and eventually for the home builders, so that there is a very clear and defined path forward on what's allowed to be developed, and that essentially the rules of the game are established and don't change during the course of it. For us, that's one of the most important things on there. We're fine operating in different regulatory environments. What is challenging and what we always push for is to make sure that those regulations don't change or move from the time that we become involved in the project until the time we exit the project. And as long as that's consistent and fair, and allows us to continue with responsible growth, then that's the environment that we think serves both Texas as well as individual homeowners best.
Yeah, and that's really important, and that's something that we really try to convey to our investors up here. I want to talk about one other thing, because I noticed this, whether it was Walnut Creek, River Ranch, Sealy, Beasley, it doesn't matter. All of these transactions, Paul, as you know, are proximate to transportation, meaning a major highway is not that far away. And one of the things that we battle up here, like literally on a daily in Toronto, is this soul-crushing traffic. So, how important is transportation, the transportation infrastructure, when you're looking at a deal? That's got to be, a pretty major factor, right?
Yeah, commuting distance and school districts used to be 20 years ago, those were your two most important metrics when you were looking at where will new single family growth happen, where will new master plan communities happen. And so those two continue to be kind of the underlying trends of making sure that it's in an environment that has acceptable school and growing or improving school ratings, as well as what is your proximity to major transportation for the purposes of commuting. One of the things that has evolved or has changed over the years, because of the ability to work remote or telecommute, whatever you want to call it, that has changed the importance of the commuting side of it. And so, traditionally, where it was 5 days a week, access to major highways so that you could commute to and fro from work, it may only be 3 days a week or 2 days a week, and it just really depends on what the individual and the job source is there. But having that ability to get to major transportation easily or quickly is still important, as big of a driver as it has been in years past. And so one of the byproducts of that is people are okay living a little further out or having commutes that, if you were doing it every day, might prove to be excessive. But if it's a commute that's only taken 2 or 3 times a week, that's a trade-off that a lot of people are okay with, to be able to get to an area where it's a larger community, maybe more affordable housing. And so there's a balance that we're always looking for on that. But yes, to your point, having access to major transportation and thoroughfares is always a critical element we're looking at. But it's been interesting watching how that's evolved, especially in the post-COVID era, where people realize they can do a lot of their stuff productively remotely, but the hybrid work condition seems to be the norm. And so we always pay attention to what are the major work areas that people will commute to, what are the different areas of employment, whether it's, different office districts in town or medical districts, things like that. So that continues to be a driver in what we look for. It's changed, as has, how working habits and what people do as far as commuting or telecommuting to work.
Right. No, that's great. Now, Paul, maybe just sort of transitioning out of residential and into another area that we just love up here is industrial and logistics. So with Gulf Inland Logistics Park, and we're in phase 2 as well, which I think is a partnership that's sort of more in the expansion phases. You can maybe just sort of talk about GILP 1 and 2 and what you intend to achieve there for your investors.
Sure. So Gulf Inland Logistics Park is a heavy manufacturing, dual rail served logistics park located north of the Port of Houston, plus or minus 50 miles from the Port of Houston area. So it is serviced by both Burlington Northern Santa Fe and Union Pacific, which are either number 1 and number 2, or number 1 and number 3, depending on how you look at it, as far as the largest Class 1 railroads in North America. And so we have access to our site for both of those Class 1 rail providers. When we got involved in this project and originally we started underwriting it, 2018 type time frame. It was following what we saw as a macro trend of reshoring or increased manufacturing activity, but domestically within US as well as in the North America side of things, where we saw more of a shift for both control, shortening supply chain lines, and frankly, just quality control, where we see manufacturing coming back to the United States, and specifically the Gulf area and along the Texas coast. We continue to see growth in that area. And so when COVID rolled through, that really threw jet fuel on that argument and turned it into hyperdrive as supply chains got stressed out. People lost control of how their inventory worked. And so a lot of companies came to the realization that while China continues to be a low-cost provider and part of their manufacturing plan, they needed local presence as well for especially critical or high-value add items. So that was a trend we saw, in the late teens, and it really started to accelerate 2020. So June of 2022, we closed on Gulf Inland Logistics Park. And so with that, we had a development agreement with both the city of Dayton and the county of Liberty County, which is just to the north of there. And that allowed for us to do the infrastructure development and rail development in that area. Since we closed in 2022 and really started development in earnest in 2023, we've had 8 separate manufacturers that have either expanded or relocated to Gulf Inland. We have 3 more under contract now to relocate. And it's everything from steel production, steel recycling, chemical blend activity, plastics related activity, petrochemical related activity for poly blend or oil blend activity. So we're seeing kind of a breadth of industries come to this area. We just recently closed with a Taiwanese steel manufacturer group that's going to be relocating. And this will be their first operations in North America. They're at Gulf Inland. We're talking to builder supply groups. They bring in a lot of the key builder supplies and infrastructure that's needed for housing, especially on the east side of the Houston metropolitan area. So we continue to see that evolve and grow and really have taken off in that area. And so we started the actual rail or infrastructure, the internal rail side of it, January of last year. Of 2025, built out just about 1,000 rail car units, as well as provided rail access to all of our tenants within the park. And so we opened that up, and it was, like I said, about 1,000 rail car storage spaces, which is integral to both the plastics and the petrochemical industries along the Gulf Coast and in the Port of Houston. And they use what they call SIT storage or storage in transit. And basically, they use the rail cars themselves as a way of using their inventory management. So they'll fill the cars, park them either loaded or empty on our site, and use more of a just-in-time inventory management for what they actually produce on site versus where they need to send their end products. And so we have rapidly approached almost 1,000 rail cars that are in the rail yard actively, really since just opening in September 1 of last year to activity. So we're already looking at doing an additional 1,000 to 1,500 rail car expansion, both in Gulf Inland. Finland 2, of which McNichol is a partner in, is really the logical expansion of that project. And we acquired that project, one, because we knew it had immediate access and availability to rail through the first project. And then 2, it allowed for larger size tenants or larger size users to come and locate in that project. Whereas maybe we were restricted on just the total area for Gulf Inland. Gulf Inland 2 allows us to entertain projects that are anywhere from 200 to 800 acres on their size and scale of that. So we have received a lot more interest this year. Beginning of 2026, I think the word finally got out. And frankly, we're a preferred provider for both Union Pacific and Burlington Northern. And they're sending people our way that are looking for relocations on there. So it's really had a lot of good tailwinds behind it. And we're just now seeing tremendous amount of activity, cash flow, and return profile that's going to start percolating through both of those projects.
Yeah. Yeah, no, that's great. And just for again, back up in Southern Ontario, for those that don't know, Dayton is about 40 miles northeast of the Houston downtown metro area. I guess with the one of the things I always wanted to wonder was like the phase 2 was more you kind of controlling the area, controlling the turf, the acreage, as opposed to just like an investment return calculation on a spreadsheet. You wanted to build this out and have a little bit more authority in the region, right?
Yeah, it allowed us to strategically get ahead and acquire, essentially another 1,100, 1,200 acres that is Gulf Inland 2.
Yeah.
That we knew we'd have access to rail. We knew we could incorporate within existing development agreement and infrastructure agreements. So it allowed us to bring that dirt to market, so to speak, quicker than anybody else would. And it allowed us to land larger users. We've had groups that came through and they wanted to be like a 500-acre parcel on it. Well, we just couldn't accommodate that because of the limitations within Gulf Inland, the first project. But being able to land some of those larger projects now with Gulf 2 as part of the project, that is a reality that all of a sudden the marketplace is now starting to recognize. And so we're seeing a lot more activity that larger scale users that can take advantage of our location and relationship with both rail lines, they can locate there. And so we're seeing direct interest on that more so now, which directly benefits Gulf 2 as well as enhances the rail activity that we see within Gulf Inland Logistics Park, the original one that we put together.
Yeah, I noticed in going through a lot of the deals, there is sort of a consistent, I guess, recipe or formula that you're using because a lot of the development and engineering partners carry over into newer vintage deals. So you're almost like rewarding success with more business. And I think that's great. When you look at some of the U.S. home builder stocks, like if you pull up a 5-year chart on, Lenore, D.R. Horton, they kind of peaked maybe 18 months ago and have been maybe going kind of a little bit sideways. Do you have any sort of guesses? I know you're not providing stock advice today, but do you have any guesses on that?
It's an interesting industry that we're in because it's a little bit of a push-pull. It's kind of like upstream and downstream within the oil side of it. When one does good, the other one might get squeezed and vice versa. And so from a developer's perspective, even though the volume was fantastic in 2020 through 2022 with interest rates low, the real benefit went to the home builders where they saw expansions in margins because prices were going up so fast. Historically, as a rule of thumb, publicly traded stocks or publicly traded home builders, we've always assumed that they do what we call a 20 and 10. They'll make about a 20% gross margin on each house, and they'll make about a 10% net margin on each house. And that was true for like decades. 2020 came through, 2020, through about 2022, they got to a point that on average, they were getting to like 30% gross margins and 20% net margins. And so they saw a radical run up on their stock prices. As things have normalized and interest rates have come back to a more, call it normal level, which actually they're probably a little bit below historical numbers, even though people still reference the low interest rate environment that we were in. We've seen, just as a general statement, a lot of those same public home builders continue to do well and continue to do fine on volume. And again, I think a lot of that is because Houston, Dallas, and San Antonio still maintain their affordability advantage as far as first-time home buyers. Austin's seeing a little more headwind than the other three markets, but they're still maintaining a lot of the same volume. They just haven't been able to hit the same kind of margins that they had previously. And so they're having to work harder on each sale. You see them do interest rate buy downs, you see amenity or upgrades that they'll pitch in as part of the deal to try to get it done. So they're having to work harder on each sale, but in an aggregate standpoint, like I said at the beginning of the call, we're still seeing like Houston, it will be 34 to 35,000 ish new single family homes. And so we're still seeing tremendous amount of volume, but it's been an exercise by both the developers and the size of lots that they are actually producing, as well as the home builders and the size of the home they're selling. It has been a continual exercise in how do we get to market an affordable, desirable product in that single family home that maintains affordability, maintains the quality side of things, and satisfies local city and county regulatory items that we continue to work with it. So everybody's kind of working towards that same solution. And it's been interesting watching it evolve. So you'll see, and we see this in every type of slowdown on a national side, size of the home actually starts to decrease. The amenity side of it starts to decrease, but the buyers traditionally, they'll trade off square footage if you maintain quality. And so we have seen that trend continue, especially in the Texas market. That trend has held true this time as it did last time. On a national level, I think it's a far more difficult process, whether it's, West Coast trying to sell homes or frankly, even the East Coast. Florida, I think, is doing okay from a volume side of it. But some of the other markets in the United States, I do know are having more headwinds than what we're having. And it is very much an affordability issue because you have that big run up in pricing. through really 23, 24, and it's still continued to move upwards, just not at the same rate that it has. So you couple that with an increased interest rate environment, and it's just tougher for the affordability numbers to match together. It is a challenge nationwide, but I think the markets in Texas have weathered it better than most. And the home builders, for better or worse, they kind of return to the historical norms of they're about a 20% on the gross margin, 10% on the net. So they had to go back to the old rules, and the party's over on the low interest rate environment. And so now they're just having to see how they compete for customers.
Yeah. Yeah. I want to pass it over to Dave. I feel like I'm sort of commandeering this call, but it's, we're in 6 of your LPs and I get to see the progress every quarter. Let's just sort of talk about from a global perspective. And I don't think a lot of people know this, but if you took the 25 biggest economies in the world, Texas would be number 9. So Texas's economy right now, when we think of U.S. states in terms of real estate, we think of growth, and it's basically a drag race between Florida and Texas. But of course, Texas is a lot bigger than Florida to begin with. And to put it in context, Texas's economy is about the size of Italy, which I think is fantastic. So,
pretty wild.
It's pretty wild, but I mean, how do you see that from a macroeconomic perspective? It's still going pretty good, right?
It is still going good. It was a lackluster year this last year on job growth versus what we have traditionally seen. And I don't think we're alone in that on the Texas market or Houston market. I think just international issues, questions on the tariffs and how that's going to play out. And then frankly, just lately, challenges in the Middle East and how the Iranian situation is going to play out. That's all impacted large capital deployment, whether you're a manufacturer looking to put $1 billion project going, even though it's on maybe a 20-year horizon that you're planning for, it's still a major decision with a lot of uncertainty going on in the background. We're fortunate that we continue to grow, just not at the same pace we have in years past. My suspicion is that we're seeing more come to bear on 2026 than we saw in 2025. What was interesting is even though we had a slower job growth in 2025 across the metropolitan areas, we saw the same amount of population. So I think it's comparatively, even though we felt slower, we were still doing far better than a lot of other metropolitan areas and frankly, a lot of other states, even within the U.S. So we continue to see in-country migration as a feeder into the Houston market as well as the other markets in Texas. So it's been interesting watching that even though there's been headwinds on the job growth side of it, the economic side of it, we're still seeing tailwinds from just pure population growth coming to town. I can tell you just from boots on the ground with our Gulf Inland project, the amount of deal flow and activity that is coming to Texas and frankly to anybody that's along the Gulf, whether it's Louisiana, Mississippi, Alabama, Florida, I think we are all seeing same kind of tailwinds on trade, local commerce, and local manufacturing activity. And we continue to see more inquiries and frankly, more deal flow coming through both on manufacturers looking to relocate as well as, frankly, just inquiries on rail relationships on whether it's storage or people needing empties or full inventory storage or frankly, expanding operations just to get a foothold inside of Gulf Inland. We're seeing a tremendous amount of activity pick up kind of at the end of Q4 last year, Q1 of this year. And I think that's indicative of what we're seeing across the Texas economy. Things are starting to move and people that may have delayed decisions in 25, it's finally coming to a point where they've got to kind of block out the noise and take the long-term view and make big long-term capital decisions. And I think more of them are getting done, frankly, now than we were seeing, 12 months ago.
Right. Right. No, that's music to my ears, Paul. I mean, that's really exciting stuff. And, just sort of checking on the time here. This has been a rapid 40 minutes. So, Dave, I don't know if you want to ask Paul anything, but this is
sure.
This is exciting stuff to me.
So, Paul, I just put on the screen here the map of Houston, and much like many U.S. cities and a few in Canada, the city grows like a concentric wheel, just keeps getting bigger and bigger, and you can see by these highways that sort of ring fence the city as you go out. Joe mentioned Dayton. I guess you're out in the northeast here. with many of
So
your
Dayton,
projects.
yeah. So
Yep.
Dayton's opened up, and really what's driven it, and it's exactly to your point. You see kind of the concentric circles continue to grow outward. So for Houston, it's Loop 610, which is the tightest one, it's actually in the city, then Beltway 8 that you see that's kind of midway out. And then the latest one, which continues to be under construction development, is what we call the Grand Parkway or Highway 99, which will eventually encircle all of Houston in that area. So once Highway 99 opened up on the northeast side of town, really changed logistic patterns and commuter patterns. And so we saw a tremendous amount of uptick, one, for our manufacturing activity for Gulf Inland, provided great access both for workers as well as access for us going south down to the Port of Houston by truck as needed. And then secondly, it opened it up from just a commute side of it, a residential side of it. And so we've seen a tremendous amount of opportunities in that area in what we call Liberty County, which is around Dayton. And it's purely because you have far better access than you've had before. And the price of property, the price of raw dirt can be acquired more affordably out there, and which at the end of the day allows for more affordable lot pricing and more affordable house pricing to the end buyer. So we've seen a lot of activity from Dayton as far as, kind of where we see the activity growing for the Houston area. We've got projects as far west as Sealy, which when you look at it on the map is out there. But when you're in the Houston area and you're looking at commutes is not necessarily out of the norm. So as far west as Sealy, we're seeing stuff up in Hempstead on the northwest side of town. We're seeing things up to Woodlands, Huntsville, and beyond Conroe to the north side of it. And then on the south side, 288, we're still seeing a lot of activity in Iowa Colony, and we will continue to see things down on the I-69 corridor going southwest, including the most recent project that we're putting together, which is called the Beasley. We're seeing continued activity down there. And that's in Fort Bend County, which has been historically one of the fastest growing counties in the U.S. and continues to do so.
That's great. Well, I'm glad I pulled the map out here. So you've got things well under control. Did you have sort of a constant inventory of land that you're looking at acquiring, or do you just do it fund by fund, or like how, without telling your secret sauce, like how do you really try
Sure.
to structure it?
Well, we always identify the property first and try to identify areas that one's going to have, good access, good quality, and have the ability to have affordable housing on it. If you're next to major corridors, that helps push things in the right direction. From an aggregate standpoint, like I said, Houston's still doing 35,000 new single family homes. And so that will eat up, just as a kind of rule of thumb, it's about 3.5 homes per acre. So if you're at 35,000 homes, that's going to chew up about 10,000 acres of gross acreage for development in the greater Houston area. So we continue to see opportunities, excuse me, kind of around the dial. And so we always focus on quality developers, quality team, and quality location, which is to Joe's point earlier, you will see many of the same consultants on some of these projects. And that's kind of by design because they have a track record and they have the experience that when challenges may come up for the developer in these projects, that they have a team in place that has been there before, knows how to navigate those waters and can be value add and quickly get to solutions to keep the momentum on those projects and those developments going. So we do not think that the Houston market is overbought. Dallas is having some challenges. I think they are frankly going to be oversupplied on vacant developed lots, perhaps significantly on the north side of it. San Antonio, we think, is probably right size. Houston is probably right size. I think Austin's got some challenges simply because they've got affordability challenges. Just the prices of homes and lots got so far ahead of itself versus median incomes that they're having to see some correction on that. So we see some pricing challenges in Austin. We see some inventory challenges in Dallas. They'll still continue to do 35, 36, 37,000 new single family houses. But in some areas of that town, they're seeing inventory issues that may go out years, where literally they'll have 6, 7, 8 years worth of inventory of lots on the ground. And we just don't see that in the Houston area. Typically, we're in that kind of 20 to 24 months worth of vacant developed lot supply. And honestly, it's consistently kind of stayed in that bracket. And so it's a healthy amount of inventory of finished lots on the ground and finished lots that are in the queue for development when we start looking at kind of a macro side of it. But at the end of the day, it's all about location, location, location. And in our case, making sure the right team is behind it from a development and engineering perspective. So we like the groups that we work with. They've been consistent. They are proven. And we will continue to go with with the proven commodity, frankly, on deals going forward. So we still see opportunities through balance of 2026. We're evaluating several more during the course of the year. At any point in time, we're probably evaluating between 10 and 20 new opportunities. And out of those, eventually, one or two will percolate to the top, check all the boxes of what we need to see from the necessary metrics and location and team that's in place on them to be able to move forward with, land banking opportunities. So we're very, very happy with where we're at. We think there's going to be continued opportunities, and we're very confident in land banking continuing to be a critical part of the capital stack for these developers over the foreseeable future.
Great. Well, Joe, we should probably wrap it up here, and then we'll stop the recording and we'll carry on for a private talk after that.
Great. Thank you, Paul.
Sounds good. I appreciate it much.
Yeah. Thanks a lot for your time. So I'm going to stop.
Absolutely. I appreciate you guys making time for it. And I think it's, not a neat way to go about, giving some kind of individualized, perspective back to, different investors so that you can play this and, they can see firsthand who's the guy behind the, the curtain that's doing all the deals and how do they do them. So, I think it's a cool way to go about it.
Okay. Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnickelasset.com to learn more.